Welcome to Debt Free in 30, where every week we take 30 minutes and talk to industry experts about debt, money, and personal finance. I'm Doug Hoyes. As I record this show in June 2015, interest rates are at record lows. If you have perfect credit, you can get a conventional mortgage for 3% or even less. With good credit, you can still get a car loan at close to zero interest. But what happens if you have less than perfect credit? The answer is that in many cases, your only option for credit is through a high-interest loan or high-interest credit card, and I can tell you there are lots of lenders willing to lend at high interest rates to people with less than perfect credit. When I started out in the debt help business 25 years ago, the big players were the finance companies, many of whom no longer exist. Today, it's not the finance companies that dominate the market. If you have poor credit, your options are the higher interest lenders, including some specialized finance companies, as well as payday loan companies and high interest credit cards. So what's the deal on high interest credit cards for people with damaged credit? Are they a good deal or should they be avoided at all costs? To find out, I've asked a provider of credit cards to people with bad credit to be a guest on the show. Before I introduce them, let me give you my standard disclaimer. The guests on this show, Debt Free in 30, are invited by me because I want to hear their perspective. I don't just invite people I agree with. I also want to make it clear that I don't pay any of my guests to appear on the show, and none of my guests pay to be on the show. Debt Free in 30 is not a commercial for any of my guests. It's a forum for my listeners and for me to hear many different points of view. So with that background, let's get started with today's guest. Who are you? Where do you work? And what do you do?
Well, thanks for having me, Doug. My name is Jim Dunbar. I am the managing partner and chief commercial officer for Affirm Financial Services.
So tell me a bit about Affirm Financial Services then. That's obviously not a big bank.
Well, we are a finance company. We are a Canadian-based finance company. We've been in market now for a little over 4 years serving Canadians. We provide consumer loans, term loans, and credit card solutions to customers who are not being served by the banks. That's probably the best way to describe it.
Great. Okay. Well, thanks for being with me here today, Jim. So let's talk about the credit card product. As I understand it, Affirm Financial has a credit card that you can qualify for even if you're bankrupt or in a consumer proposal. Is that correct?
That's correct. We have designed the product for people that are in bankruptcy or consumer proposal and for those who have been recently discharged.
Okay. So, and I understand the need for such a thing. And in fact, the question I get asked all the time by somebody who's thinking about going bankrupt is, yeah, but if I go bankrupt, I know I lose all my credit cards. How am I going to be able to book a hotel room because I have to travel for work? You know, I give them some advice on how to go about doing that, having family or friends get you a card, for example, or having your employer get you one. So it's not really your card, you're just able to use it. But a lot of people don't have that option. They don't have a family or, friend who's willing to give them access to a credit card. So that's where a service such as yours comes in. But obviously there's some costs associated with that. So let's go through the main points then of this credit card that you've got. So what's the credit limit that you offer? And let's take the case of somebody who is currently bankrupt.
Well, if somebody is currently in the process and currently bankrupt, the maximum credit limit is $1,000. When someone comes out of bankruptcy and has been discharged, that limit goes as high as $4,000.
Okay, so during the bankruptcy period, $1,000. What security deposit is required on that card?
That's a great question. There is no security deposit required on the card. And I think that is probably the most important distinction here. This is not a prepaid card and this is not a secured card. This is an unsecured credit card. It's an actual MasterCard that is made available for our customers.
So what are the qualification terms then in order to get this card?
We do offer this card to people that it's their first time that they've been bankrupt, and that they have a source of income. We verify that source of income. We think that ensuring that someone has the capacity to pay back and make the monthly payments is critical. But once that's been demonstrated, we're able to offer the card.
So, okay, so we've talked about all the good things. It's got $1,000 credit limit, even if you're bankrupt, so long as it's your first bankruptcy, so long as you've got a job or a source of income, then you qualify. There's no security deposit required. Obviously, there is a catch. What is the monthly fee on this card?
There is a monthly fee. It is $7 a month. That's the only fee associated with the monthly use of the card.
So even if I don't use it, even if I don't borrow any money, I'm paying $7 a month. What is the interest rate if I have a balance owing?
The annual interest rate on the card is 28.8%.
So just under 29%.
Yes.
So let me play devil's advocate here. Every bank in Canada has a credit card, and the typical interest rate is, 19% or lower. And most basic credit cards have no monthly or annual fee. So why should someone consider your card, which has a higher interest rate and has a monthly fee?
I think it's a great question, and it's one that I'm happy to talk about, and it's one we're very open about with our customers. The reason our rates are a little bit higher than the bank is simple. We're not a bank. We borrow our money from the bank, so our cost of funds are automatically a little bit higher than the bank. And in addition, we are also taking on some additional risk in order to provide our service, which the bank isn't able to provide. So it costs us a little bit more money, and that is reflected in having a monthly fee. But I do want to be really clear. We're not suggesting that we're trying to compete with the bank. We're offering a very competitive rate product to people where they're not able to get financing from a bank. And in fact, part of our conversation with our customers is when you can get traditional financing or you can get a card with a different interest rate at a bank, we encourage that and we support that by not having any fees associated with paying the card out early or paying a loan, more specifically paying a loan out early. We don't have fees associated with that. We want people to get the best rate they can. When they can't, we think we've got a very competitively priced product.
So you think that your typical customer will only be with you for a limited period of time during their bankruptcy, maybe for a year or two or three after their bankruptcy is finished, or until they've reestablished their credit in some other manner. You don't expect you're going to have anyone with this particular card for 10 years. Is that correct?
Well, I think that's absolutely the way to look at it. The card is there at a time when you need to start either establishing credit or you need to reestablish credit. It is a transaction-based card, so you use it for daily transactions. You mentioned earlier, renting a car, booking a hotel, buying something online. It really is designed to be a daily transaction card. The idea is that you pay it off every month. We keep the limits very manageable. And when you can find a card that's cheaper, that's absolutely what we would promote.
It still sounds kind of to me like you're kind of taking advantage of people. So a normal credit card rate would be maybe 10%, 15%, 20% with no fee. With yours, you're paying $7 a month. So even if I don't use the card, that's still $84 a year. Wouldn't I be better off taking that $84, putting it in a savings account, and so that at the end of the year I've got $84? Go out and use that money. Go out and use that money to start reestablishing your credit. It's again, it seems to me like such a high number. Do you perceive that you're taking advantage of people?
Absolutely not. I think that the price is really designed to be there to provide a facility and a utility for someone to have a credit card. There are secured cards out there. This is actually a credit card. This is a real credit card. It has a real credit limit assigned to it. It has an ability for you to use it and gain credibility at the credit bureau for purposes of your credit reporting. We report all credit payments to the credit bureau. And it is a $7 fee a month, but we kind of look at it as for $84 a year, you have the utility of a card, you have access to actual credit, unsecured credit card, and you're building credibility with every payment that you make on it to support your credit bureau score.
Well, and that's another good area to talk about then, building your credibility, supporting your credit score. I'd like to talk more about that, and I'd like to hear your thoughts on, okay, is this really building my credit score, or is that really just more of a sales pitch you're making? But before we talk about that, let's take a quick break. And we'll come back and talk about whether or not a credit card like this can actually help improve your credit score. We'll be right back. I'm talking to Jim Dunbar of Affirm Financial. You're listening to Debt Free in 30.
What are the warning signs of debt problems? Where can I find a free online debt options calculator? Where can I get free ebooks and guides? Find all the answers at moneyproblems.ca, the website for Canadians with money problems who want money solutions. Moneyproblems.ca.
You're listening to Debt Free in 30. Here's your host, Doug Hoyes.
Welcome back. I'm talking today with Jim Dunbar, who is with Affirm Financial Services. They offer a credit card that people can get even if they are bankrupt, even if they're in a consumer proposal, or even if for whatever reason they have very challenged credit. And before the break, we were talking about the parameters of this card. There's a $7 monthly fee. The maximum credit limit is $1,000 if you are bankrupt at the time you get the card. The credit limit will increase or can increase once you're discharged from your bankruptcy. And then there's also an interest rate, 28.8% if you're carrying a balance every month, which I think kind of defeats the purpose of a credit card like this, but it's that's the parameters. So I said to Jim before the break, boy, that's awfully expensive, isn't it? And he said, yeah, it's expensive, but there are, number one, not a whole lot of options. If you need a credit card while you are bankrupt because you need it for work, you need it to book hotel rooms, then this is an option. So long as you pay it off every month, the cost is $84 a year for that credit card. You've got to decide for yourself whether that makes sense. Now, the other point that Jim made just before we went on break was that this actually also helps you improve your credit score. So let's talk about that. So and maybe we can start with some basic definitions here. What are the kind of things that go into your credit score? And I know, Jim, you're not a representative of Equifax. Neither you nor I know their secret formula, but give me a bit of an overview of the types of things that go into a credit score, and then we can bring it back to this card in particular.
Sure. Well, I like this question, and you're right. I'm not representing the Bureau on this answer, but I can tell you about some of the kinds of specifics that do drive the score. It's a difficult question to answer, but it is one that, and it's difficult because it calculates so many different variables, and it's very specific to an individual's actual credit information. So there are a lot of different calculations that go into it. But to give you some examples, it looks at things like the length of time that you've been on the credit bureau. It looks at things like payment history. It looks at how long that payment history has been in effect. It looks at very unique demographic information specific to the individual. It looks at things like recent inquiries where financial institutions may have been, or whether or not the person has been seeking credit. It looks at a very important one is utilization of credit. So it does a calculation and looks at, of the credit you have available to you, how much of it have you used and how well are you paying it back as per the terms. So those are examples of the kinds of things that really can impact somebody's score. And so there are a lot of calculations, but those are the kinds of things that people can be aware of.
Okay, and we've talked before on this show about credit scores and how they work, and I'll put some links in the show notes to some of that information. So, okay, we understand there's a bunch of parameters that go into it. Do you have any evidence that your specific card actually helps? So, I mean, I totally agree with you. The longer my payment history, the better my utilization, the better my credit score. But what about your card in particular? Do you have any evidence that your card actually helps people improve their credit score?
Well, again, I think it's important to note that it is one variable in a series of quite a few calculations. But we did do a sample of 2,000 of our accounts. We looked at accounts that were in bankruptcy or some that had been recently discharged. And we took a sample of 2,000 accounts dating back to 2012. And we looked at those accounts, and we were very pleased to see that over 65% of those accounts in that category had a score range of 675 or better. What that score really means is the banks kind of look at between 700 and 675, 680 as where they have a cutoff, if we want to call it that. That's a range, I'm guessing a little bit. That's about where they are. 65% of the accounts that we looked at in that very short amount of time had now achieved that rate. And we know that part of that process is impacted by the fact that they had an active credit card with us that they were paying according to the terms. So they were paying it well, and their scores were going up. Now, there are other factors, but it's a really good indicator. 43% of those accounts were up over 700. So that is a really impressive improvement for those accounts, which we know we can have, or we are having some impact. And I think what's important is we're trying to give people the ability to start making that impact sooner. So while people are in bankruptcy, they're using the card and they're getting that benefit and they're creating that history. And I think that's a really important distinction about what this card can do, because it really is trying to get the process started earlier.
Do you have any knowledge of what the person's credit score would have been prior to starting? So what you're saying is we looked back and somebody who got our card a year or two ago may very well have a credit score of 700, which is, starting to get into a decent range. Yeah. But did that person have a credit score of 700 2 years ago anyways? Do we have any way of knowing whether the card was actually a contributing factor to that?
Well, I can assure you that they're very unique, but it's really difficult for me to give you that level of detail because we have to aggregate the results.
Sure.
But that said, I think there would be very few to any that would even have been anywhere near that range because of when they applied for credit. Their credit scores were actually quite low. They're as low as 4 or 5 and low 600s most on average. So really, we're talking about accounts that probably had very poor scores who have actually made some pretty dramatic improvement.
And I understand that. Obviously, you're not going to release individual client information here. That's not possible. But what you're saying is you've taken a sample of a couple of thousand people and you took a look to see, well, roughly what their credit scores are when they start the program because they are either in bankruptcy or just out of bankruptcy, they're in a consumer proposal, or for some other reason they have not great credit. And those people would typically have scores of, 400, 500, high 500s, maybe into the low 600s. And by the time a year has gone by or 2 years have gone by, obviously being discharged from bankruptcy is going to have a positive impact on their score. But a significant chunk of those people now have a credit score of 700 or higher. That's what you're saying. So does having a higher credit limit matter? So I can go out and get a secured Visa card for, let's say with a $500 limit. I can get your credit card, even if I'm bankrupt, with up to a $1,000 limit. Once my bankruptcy is finished, the limit can increase. Does size matter when it comes to the outstanding availability on your credit card?
Yeah, I think I'll answer that question. The answer is yes, it can have an impact. And I think the best way to describe it probably would be with an example. So if someone has a $1,000 credit limit, and on average they carry or use $500 of that in a particular month, or on average that's what they use, they're utilizing 50% of the credit that they have available. If somebody had that same payment pattern and they had a limit of $2,000 on the card, now they're using half of that, so 25% of the available credit. And what the calculation is really looking at is a bit of size matters. So it does matter what the limit is. And then, but a more important calculation is really how much of what is available to you have you used? And I think that, so limit can make a difference, but it is consistent with if you has your spending pattern stayed consistent. That's probably the better way to approach that question.
Yeah, and we don't know what the exact formula is with the credit bureau, but the people I've talked to have told me that, the utilization of 20% is a lot better than a utilization of 80%. So the bigger amount of credit that you have access to, but you demonstrate you're responsible by using only a small portion of it, therefore makes a difference. So I guess the concluding comment then in this segment would be that the $84 a year it's going to cost me to pay the $7 monthly fee on a $1,000 credit card is actually also helping improve my credit score longer term. Is that essentially what you're saying?
Yes, absolutely.
Okay, well that's very helpful information. So I know you also have a term loan product. We've only got about a minute here, but the term loan product is something once your bankruptcy or once your consumer proposal is finished. Is that correct?
That's correct.
And the maximum you can get on that term loan would be how much?
Would be $5,000.
And the interest rate on that would be how much?
Those interest rates also start at the 29% range.
And could be, a bit higher than that. And what's the monthly fee on those loans?
There are no fees. There are no monthly fees. So it is just an annual percentage rate. And I think what's worth noting on these is these are also unsecured loans, and they are open. They have a term to them. But if someone would like to pay it sooner or pay it off faster than the term, there are absolutely no penalties to that. So if someone can borrow the money at a better rate throughout that term, we encourage them to take advantage of that, and there are no penalties associated with paying it sooner.
And in effect, you already said that in the first segment. What you're really trying to do is get the person into a better position, and you assume that 5 years from now, they're probably not going to be your client anyways because their credit will be such that they can borrow at a better rate. So I think that's a great way to end this segment. Jim, thanks for being here today.
Well, thanks very much for having me.
Great. Thanks very much. We'll be back to wrap it up right after this on Debt Free in 30.
If debt problems are keeping you up at night, if collection calls leave you afraid to answer the phone, it's time to end the cycle. You can do something about your debt. Call Hoyes Michaelis today at 310-PLAN.
You're listening to Debt Free in 30. Here's your host, Doug Hoyes.
Welcome back. It's time for the 30-second recap of what we discussed today. On today's show, Jim Dunbar explained the features of their credit card product for people who are in bankruptcy or who don't qualify for a credit card from a traditional bank. That's the 30-second recap of what we discussed today. As I said during the show, these credit cards carry a monthly fee and a high interest rate, so you should only get one if you have no better options and if you will be disciplined enough to pay it off every month and to replace it with a less expensive option once you've rebuilt your credit. That's our show for today. Full show notes, including links to the products we discussed on today's show, are available on our website at hoyes.com. That's HOYES.com. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.
Looking for information on budgeting, debt consolidation, credit counseling, debt management, and debt settlement? For unbiased advice, go to moneyproblems.ca, the website for Canadians with money problems who want money solutions. moneyproblems.ca.